Chapter 5 begins on page 169 in the textbook. On this page, the author claims that you'll learn everything you need to know about revenues, costs, and expenses in this chapter. It is actually just an overview of these topics. This PowerPoint will help direct you to areas of discussion that our Accounting 100 class will focus on. Further financial and managerial accounting studies will be a more complete picture of these topics. There is a difference in reporting between service and merchandising companies. One requires a single-step income statement and one requires a multi-step. I will refer to the income statement also as the profit and loss statement or the P&L. In business, the terms are interchangeable. Please note that a service company, you begin with the revenue minus the expenses, while on merchandising company statements, you include cost of goods sold in addition to revenue and expenses. Some examples of a merchandising company would be Target, Bashas', or Walmart. Types of service companies could be accounting services or housekeeping services. Let's take an example of a merchandising company that sells shoes. At the time of the sale, you would record the sales revenue and also the cost of the inventory that was sold to the customer. In this example, the sale of one pair of shoes would show revenue of $100 and cost of goods sold of $60, resulting in a gross profit of $40. There are two basic inventory systems used to track inventory assets as well as the cost of goods sold. They are perpetual and periodic inventory systems. You can pause the PowerPoint to read this slide and the next couple of slides. Most large retail companies use barcodes for scanning in order to both track the cost of sales and to track items in inventory. This type of technology is used for the perpetual method of maintaining inventory. Take a moment to read this slide and the next slide. When revenues or sales are recorded, the account is credited. So sales revenue would be credited in order to increase the revenue account. A debit to sales would be a decrease to the revenue account. Most sales are also subject to sales tax. Sales tax is not revenue or income to the company. Taxing authorities require businesses to collect sales tax and then to remit it back to the state or to the local government. Remember, sales tax collected by the company is not income. With some sales, the customer pays cash. Other sales are made as credit, which allow the customer more time to pay for the purchase. This type of credit sale requires the company to maintain accounts receivable at the time of the sale and also a corresponding detailed customer ledger. Then, when the customer pays the cash, another transaction is necessary to record the cash and also to record the payment of the receivable. All sales documents must be maintained by the business. Using pre-numbered documents allows management to ensure that all transactions have been captured and recorded. We are all familiar with expenses in our day-to-day lives. Examples are food expense, clothing, and housing-related expenses. Here are some common business expenses. Can you think of others? When expenses are recorded in a journal, they are increased by debiting the account, and they are decreased by crediting the account. All expenses should be supported by a paper or electronic proof of payment. Businesses should avoid using actual cash for expenses, as it is much more difficult to have an audit trail. One type of expense that is recorded without a receipt is depreciation expense. Depreciation is recorded in the financial records using a journal entry to record the expense as the asset is essentially being used up over time. Salaries and wages expense can be the largest single expense of a company. It also requires additional forms and reporting. If a company does not comply with local, state, and federal taxing authorities, they can be subject to very high penalties. So, it is important to properly record salaries, withholding taxes, and to pay payroll taxes to the taxing authority in a timely way. To summarize, the basic financial statement, profit and loss, or another name for a profit and loss is income statement, is to report the revenues and subtract the expenses in order to arrive at the net income or loss for the company. This is how you know if your company is successful. We will spend more time on financial statements in the next chapter, Chapter 6.